Hi, today I'd like to use one of my favorite devices, something I fall on all the time in my corporate finance and valuation classes, to kind of give you a synthesis of almost everything I talk about in these classes. So here's the device. I call it the corporate life cycle. Just as human beings are born, grow up, age, and decline, companies go through a life cycle. There's a startup phase. We come up with this great idea, an idea that you're not sure will work, but an idea that you think might make you money. In the second stage, you convert that idea into a commercial product. In the third stage, that commercial product kind of kicks into growth and starts delivering revenues. In the fourth stage, you start to see earnings from those revenues. And then in the fifth stage, you start to mature as a business where your growth drops off, but you still make money. And then there's decline. Now, of course, lots of businesses never make it past the first stage. Quite a few don't make it past the second stage. But if you look at any large company today, any successful business, it has gone through most of the phases of this life cycle. Now, the reason I like the life cycle is it, in a sense, allows me to compress what I do in a 26-session corporate finance class into 2 minutes. Here's a way to think about the three big decisions that every corporate finance class is built around. There's the investment decision, the financing decision, and the dividend decision, right? So if you think about it in the context of the life cycle, here's how it plays out. Early in the process, it's the investing decision that rules. It's the big projects you take that will determine whether you make money or not, whether you will succeed as a business. As you age, the focus shifts to the capital structure decision. How can you lower your cost of capital? And here's why. If you have great projects, you're making 35, 40, 45% returns. Who cares whether your cost of capital is 12% or 10%? So as you age, capital structure kicks in. And then as you start to go into decline, dividend policy starts to rule. In what sense? You're liquidating your business. You're harvesting your business. So the investment principle, the financing principle, and the dividend principle essentially vary as you move through the life cycle, and how much emphasis you put on each will shift as well. And here's very simply how you can think about the corporate finance decision making at a company based on where it is in its life cycle. Early in the process, young companies should be focusing almost entirely on the investment decision. They shouldn't borrow money for an obvious reason. You can't make interest payments with hope and prayers. And you can't pay dividends because you need every dollar of cash you make to go back into the business. As you age, here's what's going to happen. Your earnings are going to start to pick up and your investments are going to start to get less attractive. At some point in time, the cash you generate from your business will start to exceed what you need to reinvest in the business. That's when both your debt capacity and your dividend policy kick in. Most companies will fight this. They want to stay young, but the way this will manifest itself is your cash balance are going to get very large, and at some point you got to face reality and return that cash back to the investors. And when you go to decline, your revenues start to drop, your margins start to shrink, and you should be thinking about how to gracefully liquidate your business. So that's corporate finance on one page. Let's in fact now use the life cycle to talk a little bit about investing. In my valuation class, I make a big deal about narrative and numbers, connecting stories to numbers. And if you don't have a story, I firmly believe that your valuation is just a collection of numbers. Now, if you think about how important stories and numbers are in a valuation, it varies again across the life cycle. Early in a process, you're a startup, it's all about story, right? So if you can tell a really big story and it's plausible, you're going to get a big price for your company. So it's all about telling the right story. So founders and entrepreneurs need to be good storytellers, and the story needs to be gripping, big, and potentially lucrative. As you go through the life cycle, though, people are starting to look for substance. They're looking to see whether you can deliver on this story. So the focus starts to shift on, you told me a great story, now where are the revenues, where are the earnings? I call these bar mitzvah moments when the market shifts from looking at the story to looking at numbers, and you have to be ready as a manager. Now, as you go into maturity, the story starts to matter less because, in a sense, it's like being in chapter 32 of a 36-chapter book. You can't rewrite your past. You're already established as a company. The numbers start to drive the story rather than the other way around. And when you go into decline, there's really not much of a story you can tell other than a depressing story or a horror story. And you have to think about essentially letting the numbers drive the story you're telling to the market. So that's narrative and numbers. Now let's see how this plays out in terms of the skills you will need as a CEO at each stage in the process. Early in the process, you need to be a great storyteller. who can also provide, at the same time that you're telling the story, a measure of plausibility for the story and get your audience along. As you move through the process, you have to be a manager or a founder who acts consistently on that story. Are your actions consistent with the story? Something that a lot of top managers are unable to do. But are you acting consistently with the story? So if your story is of high growth, are you acting as if high growth is what's driving your decision making? As you mature as a company, your role becomes more protective. You already have a story out there. You're making money off that story. You have to protect yourself against assault from competition, from regulators, things that will chip away at your story. And as you go into decline, the story you're telling me is one that reflects the reality you face, which is you're a shrinking company in a shrinking business. That's the story I want to hear, not a fairy tale. So you can already see that what makes for a great CEO at a young startup will not be the same set of qualities that will make for a great CEO at a mature firm, which again will not be the same as what you want from a great CEO in a declining company. So the skill set I will draw on you will vary across time. And that's partly why I think you can have people, founders, CEOs who do really well when a company is young and then start to get into trouble as the company matures because it's calling on a different set of skills. Now, if you look at the life cycle, clearly there's far more uncertainty early in the process because you really don't have much to show. You don't have any history, you don't have a business model, you're not sure about the market. There's tons of uncertainty. But the nature of uncertainty also shifts. So while both the magnitude goes from high to low as you go from early in the life cycle to later, this type of uncertainty you face will also change. Early in the process, much of the uncertainty is about you as a company, your business model, your competition. As you get more mature as a company and you have more substance, you have more assets in the ground, you get more exposed to macroeconomic variables. What will interest rates do? So if you're a young startup, you shouldn't be sitting around saying, what will the Fed do to rates? Because in a sense, it's a side story from your perspective. You're affected primarily by uncertainty around your business. Now, this uncertainty shifting over time also creates consequences in marketplaces. I firmly believe that most companies are priced, they're not valued. What I mean by that is you price them based on what similar companies are being priced at. Early in the process, there's a very simple reason for it. Most VCs, most people looking at young companies say you can't value these companies, there's too much uncertainty. So what they try to do is price these companies. But the problem they often run into is what do you price it against? If it's a startup with no revenues, you can't divide price by earnings or price by book value or price by any of the variables you get used to using public companies. So early in the process, you're dividing price by potential market. As the company starts to show some business, you start dividing price by other metrics. So the dot-com companies, you started to see people dividing price by website visitors. In social media companies today, you see price per user. Again, a very intermediate variable, but in the face of uncertainty, what investors say is, look, I don't know how to value this company, so I'm going to price it based on what I can see. Here again, the bar mitzvah moment kicks in. At some point in time, investors stop being happy with users and start looking for revenues, earnings, cash flows. And you have to be ready because the pricing metrics will start to shift again. They'll shift from price per user, price per subscriber to price to revenues or enterprise value to revenues. And then as you start to make money, you're going to start to see the earnings multiples kick in, price earnings, EV to EBITDA. And then when you go into decline, you're going to see a lot more use of book value multiples on the basis that book value is often a substitute for liquidation value. You can already see why the metrics you use have to vary across the life cycle and why, if you're comfortable with only one metric, let's say PE ratios, you're not going to be able to make good investments early in the process. So you have to be versatile. You have to adjust your multiples as the life cycle goes through. Which brings me to my final slide. I'm not a trader. I don't like pricing. I value companies. And I'll make a confession. I love valuing young startups. I love valuing them precisely because there's a lot of uncertainty. But I won't tell you that the challenges I face when I value a young company are the same as the challenges I would face when I value a mature company, which might be, and the challenges there might be very different from the challenges I face when I value a declining company. When you look at young companies, here are the big questions that drive your valuation. What is the total market for the company? Some of you might be familiar with my Uber valuations, might know that my valuation of Uber shifts dramatically depending on whether I call it a car service company or a logistics company? What kind of market share do you see this company getting? And that'll require understanding of networking effects and competitive advantages and what will happen. And what kind of profit margins do you see this company having? This might seem tremendously speculative early in the process, and it is. But so what? It's not as if there's somebody out there who knows the answers to questions. You have to use the information you have to try to make the best judgments you can. And all too often, when you're looking at young startups, you're valuing not just a traditional set of cash flows, you're valuing some optionality. What do I mean by that? These are heavily skewed distributions, heavily skewed in the sense that if things go wrong, the companies are worth nothing. But if things go right, your investment could quadruple, go up fivefold, tenfold, 15-fold. So there has to be an element of optionality that you have to bring into the process that allows you to differentiate across investments. As companies mature, more conventional discounted cash flow valuations work. What are more conventional valuations? These are the ones that you're often taught to do in a modeling class, where you take revenues, you take history, you project out future revenues, you take the past margins, you forecast them out. Those work fine if you have a mature company, but if you try them on a young company, you're going to very quickly run into brick walls. When you get into decline, the biggest challenge you face is psychological. In decline companies, growth rates tend to become negative. So you have to be willing to work with declining revenues, shrinking margins, debt that has to be paid off, liquidation along the way. Not difficult in terms of technique and how to do it, but difficult psychologically because we're almost hardwired as human beings to be optimistic. So think about the life cycle because it's a surprisingly powerful device to understand corporate finance, investing, pricing, and valuation. And I hope you found this session useful. Thank you.